Assalamualaikum, my name is Nurul and Izzatie Binti Rosdin.
Assalamualaikum and hi, my name is Noradlina Binti Redzuan.
Hi, Assalamualaikum. My name is Siti Hidayahtul Solehah binti Mohamad Ismail Selloo.
My name is Nurain Amirah binti Zai'in.
My name is Nurul Alia Tajudin.
Currency exchange rate play an important role in a country's export and import, economic growth, capital flows, inflation, and interest rate. During the Asian financial crisis, Malaysian GDP fell from $100.8 billion in 1996 to $72.2 billion in 1998. A speculative attack on the foreign currency market was one of the causes. The ringgit's value remains vulnerable to misconception about the country's excessive reliance on commodities. There is fear that the ringgit will become less competitive and the currency's value will become more volatile. Despite this, Malaysia reaps a slew of advantages that will aid its economic development. The purpose of this research leads to examining the determinants of the Malaysian exchange rate volatility and its recent performance against US dollar. In specific, we choose to compare our ringgit Malaysia against the US dollar because despite trillions of dollars in foreign debt and ongoing huge deficit expenditure, the United States continue to have international trust and confidence in its capacity to meet its obligation. Consequently, the US dollar continues to be the world's most valuable currency. In the years ahead, it may remain the world's most valuable currency. Thus, our findings offer an understanding of the exchange rate determinants which were contrary to previous studies in terms of scope by adopting data until 2020, and this makes it relatively more recent compared to other studies. The study's findings serve as the foundation for better interpretation, making it easier and more convenient for the community to get more knowledge and advantages. Researcher and investor can use the research information to learn how exchange rate volatility is affected by various factors. As a result, this will be useful as the guideline for investment decision as well as understanding economic growth performance. Moreover, the firm will benefit from this discovery so that they can use the results to direct their economic or investment activity and analyze the factors influencing the firm's value. It will be useful for investors in this case to reduce or prevent loss.
For the literature review, this part is basically about the relationship between the dependent variable of this thesis, which is exchange rate volatility. Meanwhile, the independent variable is gross domestic product, interest rate, inflation rate, and also foreign direct investment. For the nominal exchange rate theory, we took it from the past research, which is Kandil 2014. The title is Exchange Rate Fluctuation and Economic Activity in Developing. So in this journal, they said that the cost of output produced is determined by anticipated exchange rate movement, which have a long-term effect. For the second theory is changes in the nominal exchange rate have significant implication on the actual economy, and identifying this driver can provide helpful information to policymakers and market participants. This journal is wrote by NG and Lita, which is the impact of monetary variables on the exchange rate in Malaysia. So we move to the literature review of independent variable for this thesis. For the GDP, according to Callan in 2020, GDP is significant because it provides information on the size and performance of an economy. Second, the impact of critical macroeconomic variable relationship on exchange rate was studied according to Ramasamy and Abba in Journal Macroeconomic Variable on Exchange Rate in 2015. For the interest rate, first, TAFA in 2015 research for case of Albania shows a positive relationship between interest rate and exchange rate. Second, for the Michandi in 2013 research studied the macroeconomic determinant of exchange rate volatility in India. For the inflation rate, the exchange rate according to Datuk Nur Syamsiah, Governor of Bank Negara Malaysia, is one of the most significant influence on Malaysian inflation rate. Second, the higher inflation leads to an increase in interest rate, which leads to an increase in capital inflow, causing the exchange rate to fluctuate. As a result, inflation has a negative rather than a positive effect on the exchange rate. Based on Isa Ramli in 2020, the journal article is the determinant of exchange rate volatility. For the foreign direct investment, FDI is a critical component of integration, economic integration. FDI also promote technology spillover, helps with a more competitive business environment, and promotes enterprise development. This is from OECD 2022, which is exchange rate volatility and securities transactions.
In this chapter, we will describe the methodology and the procedure we use to complete our data collection. All the data of exchange rate volatility and the 4 variables of economic growth are collected from the Department of Statistics Malaysia and the World Bank Open Data. This analysis used annual time series data with 31 observations spanning the years from 1990 to 2020. In this research, the target population is Malaysia, a country in Southeast Asia with 13 states whose government is a constitutional monarchy with an elected parliament. We also choose EView 12 to be our sampling technique. This study applied descriptive analysis, correlation analysis, classical assumption test of multicollinearity and normality, and also the regression analysis to conduct the statistical testing. Now we go to the theoretical framework. Theoretical framework is explained about the relationship the independent variable and dependent variable. The independent variable is gross domestic product, interest rate, inflation rate, and foreign direct investment that influence to the dependent variable, which is nominal exchange rate, where it affects economic growth. Theoretical framework also the clarification of dependent variable toward each of the independent variable. As our dependent variable is nominal exchange rate, it is measured by the real useful exchange rate index 2010 equals 200. Meanwhile, for the independent variable, first is gross domestic product. It is measured by the GDP per capita constant 2015 US dollar. And then for interest rate, it is measured by the lending rate in percent. For the inflation rate, it is measured by the consumer price index. And last but not least, foreign direct investment is measured by the foreign direct investment net inflows in percent of GDP.
We end the result analysis in chapter 4 with regression analysis. It is a popular market research approach that helps in analyzing the connection between independent variables and dependent variables. It focuses on how the relationship between variables and identify which one can be accepted or rejected. The R-square values indicate that the variability of the independent variables explain 81.43% of the variation in the dependent variable. The p-value statistic of 0.05 is utilized to examine the overall significance of the regression model, which is allowing researchers to reject the null hypothesis. However, the adjusted R-square is 78.57%, which is less than the R-square. This means that the variables in the regression model is good match to focus. So based on the result shows that the p-value for foreign direct investment are 0.1954 at a 95% confidence range. Thus, there was no relationship found between them. Then the result in the figure shows sufficient evidence to conclude the significant relationship between the gross domestic product and foreign exchange rate at a 5% level of confidence. As the GDP beta coefficient shows a negative value, it can be concluded that there is a significant and negative relationship between them. Next, the exchange rate volatility has a significant and negative relationship with inflation rate, as the results show 0.0025 at a 95% confidence interval and a negative coefficient. Lastly, the result shows that the exchange rate volatility and interest rate is insignificant as the level of p-value is less than 0.05 and negative relationship with interest rate, which is the result shows 0.6554 at a confident interval. The regression analysis formula is derived from the p-value and is summarized in the table, where the result shows that the foreign direct investment and interest rate are not significant, thus fail to reject the null hypothesis, while gross domestic product and inflation rate are significant that can reject the null hypothesis.
Finding on major discussion. Firstly, research objective 1. Based on past result, the findings show a significant relationship between exchange rate volatility and GDP. This result can be supported by past researchers such as Mohamad and Abdullah in 2021, Ramzi and Abar in 2015, and Michandi in 2013. According to Ramzi and Abar, they studied the critical macroeconomic variable relationship and their influence on exchange rate and found that GDP can influence exchange rate. Secondly, based on the past result, the finding shows an insignificant relationship between exchange rate volatility and interest rate. This result is supported by past researchers such as Ramzi and Abar in 2015, Michandi in 2013, and Cruz in 2013. Anita Michandi indicates that in her studies, interest rate has a negative correlation with exchange rate. The investigator has observed that where there is a rise in interest rate, there is a negative correlation between interest rate and exchange rate, and that would lead the home currency to depreciate. Next, research objective 3. Based on the past result, the finding shows a significant relationship between exchange rate volatility and inflation rate. This result is supported by past researchers such as Mirchandi in 2013, Kashif in 2011, and Achsani in 2010. The reason it is significant because based on Achsani studies, he discovered the inflation rate offers the correct indication between exchange rate connection and that it is significantly larger in certain nations than in others. Last but not least, based on the past result, the finding shows an insignificant relationship between exchange rate volatility and FDI. This result can be supported by past researchers such as Trishel in 2019, Al-Abri in 2015, and George and Wakelin in 2002. The reason it is insignificant is because based on Trishel's studies, they found that the impact of exchange rate on FDI is insignificant because their probability values are more than 0.05 and their computed statistics are lower than 2.131. And that's all by us. Thank you.